Good morning. So this is the first in the series. We're going to explore every single token we have in our portfolio. And this presentation is exclusive for our clients. And our first analysis will be on the Compound Protocol. So basically, Compound Protocol is a money markets protocol. Its main focus is to provide a spot interest rate to every crypto asset in the Ethereum blockchain. And the protocol started in 2017 with the founder being Robert Leshner. So here are the founders. Robert Leshner, the founder, he currently has 4.02% in tokens, and Geoffrey Hayes is the CTO and also co-founder. First, Robert Leshner, it's a CFA, and he has experience in the bond market as he has previously worked there. And Geoffrey Hayes, the CTO, is a software engineer, and was one of the main designers of the smart contract behind the protocol. And the main token holders of the protocol are A16Z, also known as Andreessen Horowitz. It was founded by Mark Andreessen and Ben Horowitz, and they currently have 13.14% of the voting weight in the protocol. The second largest token holder is Polychain Capital. It's a hedge fund which actually manages only digital assets, and it's extremely big fund in the space. I'll show you later. In the next slide, we'll explore in depth the three biggest token holders. Our third investor is Bain Capital Ventures. It's a subsidiary of Bain Capital, which was founded by Bain and Company, the consulting company, and they have currently 9.78% of the protocol. So in the graph below, we can see the wallets with specific tokens amounts and the number of them throughout each month. This is possible with blockchain behind as the main settlement layer, ledger layer, because it's extremely transparent and we can explore in depth several types of wallets. So in the first line, we have wallets with more than 100,000 tokens, and we can see that in the last months, it has been growing but steady. And with wallets in the second line, we have 100,000 tokens to 10,000 tokens, and it also has been growing in a consistent rate throughout the last 4 months. And below, we have wallets with 10,000 to 1,000, 1,000 to 100, and subsequently, we have wallets with lower amounts of tokens. And we can see that consistently, the number of wallets with large amount of tokens and small amount of tokens has been increasing the last 4 months. This shows that the protocol token, the comp token, is being bought, and increasingly there has been more and more investors in the protocol interested in it. So this is extremely favorable to our investment, as it shows that people actually are looking into the protocol. And we'll explore further in this presentation several aspects of the protocol, and we'll end the presentation with valuation and what we can expect in the future for the protocol. So let's dive in depth in the three main investors. A16Z, as I said before, it's Andreessen Horowitz. It's a large venture capital, one of the largest in the world. It has $18.8 billion in assets under management and 3.1 billion in digital assets in 2 funds, and they just raised their third fund in the amount of $2.2 billion. It was founded in 2009, and they invest in all types of fintechs and techs in general. And one of their main investments in the digital asset space is the YDWX. It's a exchange, centralized exchange maker. It's a bank inside Ethereum blockchain. Then you also invest in Polychain Capital, was one of the main seeders of the fund. Dapper Labs, which is behind the NBA Top Shot, which is behind the famous NFT bubble we saw earlier this year. Uniswap, which is the largest decentralized exchange in the space, currently has a volume more or less 1/3 of Coinbase. DM, which is the stablecoin of Facebook. Compound, and OpenSea, which is the largest marketplace for NFTs. And there are also some noteworthy investments that A16Z made in the traditional equity space, which include Coinbase, Instagram, GitHub, Lyft, Facebook, and Airbnb. So looking at their portfolio, we can see that they are actually targeting companies which has global potential and which also has the potential to disrupt industries in which they act on. The second largest investor, Polychain Capital, was founded by Olaf Carlson Wee. It's located in San Francisco. It invests in seed to late stage, and its main focus is only in the blockchain space. Current asset under management is $2.1 billion, and it actively manages its portfolio of assets. It was founded in 2016, right before the 2016 crypto bubble we saw. And their main investments in their portfolio include the YDWX maker, 0x, which is also another decentralized exchange, Compound, and Coinbase. And our third largest investor is Bain Capital Ventures, which is a subsidiary of Bain Capital. It was founded as an investment branch of Bain & Company, the consulting firm. It's located at Palo Alto, and it also invests in seed to late stage venture. And its portfolio consists of all types of ventures, fintech ventures, and techs from other sectors also. It's Bain Capital, the main investment branch, consists of AUM of $120 billion, and its venture branch includes a portfolio of $5.1 billion. The parent company, Bain Capital, was founded in 1984, and its venture branch was founded in 2001. So main active portfolio in the digital assets play include Compound, BlockFi, which is a centralized lending place for people to deposit their assets and receive interest rate. DocuSign, which is not from the digital asset space, but it's also noteworthy active investment they had, and Digital Currency Group. Some of its noteworthy exits include LinkedIn, Minute Clinic, Bluestem, Jets, and Booker. So an overview of these three main investors, we can see that three of them are extremely specialized in the tech space, and they invest in companies which aim to be global disruptors, and they aim to see the world in 5 to 10 years and how they would change. So it's good to put that in mind. Once our main focus is Compound, and we from the Apollo Fund see as Compound as being one of the main Legos of the DeFi space, which is the decentralized finance, and one of the principal components of the growth of this space, as they aim to be the safest bank in crypto and the base layer for the spot interest rate market. So let's proceed. So let's first talk about how Compound came to be and some of its noteworthy events. So Compound was founded in 2017. It was founded by actually Compound Labs, which actually created the protocol, Compound Protocol. Compound Labs is independent from the Compound Protocol, and anyone can build on top of the protocol as it's open source on the Ethereum blockchain. But Compound Labs also are one of the players that builds on top of it, as we'll see later, by its main by its latest news. So in 2018, the Compound launched its Compound protocol on the Ethereum blockchain. By June 20, it launched its Comp governance token, which is a DAO, which governs the Compound protocol code and its treasury. And it's really important to understand that the Comp token holders have the full autonomy to control the changes in the code of the protocol and any use of its treasury. It includes from how many collateral you can put to how much they're going to distribute dividends, future possible dividends in the future. So Comp token holders have the complete autonomy to control everything. And it's extremely interesting to know that Comp was listed in Coinbase in less than 10 days. It's extremely rare, as Coinbase had to do extremely strict due diligence to the token they list in their platform, as Coinbase is the largest player in the exchange space and has the largest user base also. And by July 2020, Comp token holders replaced the original board members, and now they are the sole administrator of the protocol. By November 2020, unfortunately, the Oracle, which feeds the protocol data about assets, got exploited and $93 million got liquidated. It's extremely important to understand that the smart contract, the protocol wasn't hacked. The Oracle, which provided input to the protocol, got hacked. And this generated misinformation to the protocol, and this caused 93 million to be liquidated. Changes has been made to the protocol as previously the feeder of data to the protocol was a Coinbase, and now they recently added Chainlink. Chainlink is a decentralized data feeder, basically, and its data comes from several sources. So now it's extremely hard to hack the Oracle, which inputs data to the protocol. Chainlink is in the industry standard, and it has never been hacked in any protocol. It secures over billions and billions of dollars in several other protocols and exchanges and several other places. So let's continue. By December 2020, Compound grew to a total locked value of over $12 billion. So it grew from November 2009, which consists only $150 million, to December 2020, $14 billion. So it's a over 100 times increase of its value locked inside of the protocol. The value lock is basically the total amount of dollars in tokens that the protocol currently has to lend. By March 2021, there was a proposal to include a gateway, which is a cross-chain feature, which allows Compound to act in several other blockchains, which includes also permissionless and semi-permissionless blockchains. It's extremely important, as Compound will be able to interact with, let's say, a Fed blockchain, Federal Reserve blockchain, or a UCB blockchain. So once central bank digital currency enters the blockchain space in the form of tokens, Compound will be able to work with them, and this will generate extreme value to the protocol, as it will attract capital from everywhere and every place. So by May 2021, there was a market crash, as you guys have read in my last investor letter. It was one of the main crashes in the space, and it started with the liquidation of shorts, of longs in the derivative space. was the first crash, but the second crash was led by the DeFi space, which the many protocols were forced to liquidate many of their positions as the market crashed too fast, too far for people to add extra collateral. And the compound liquidated over 250 million of its positions. So, and by June 2021, one of the most noteworthy events of the protocol was the launch of Compound Treasury by Compound Labs. It's basically an on-ramp for institutions. So basically, the Compound Treasury is a fintech like any other fintech, but its backhand is a Compound protocol. So basically, people just make a wire transfer to their Compound Treasury account, and the Compound Treasury will basically do the whole road to access the protocol. And they're currently offering a fixed interest rate of 4% per year. This is extremely good as the interest rate of the traditional market now. Spot interest rate market is below 50 basis points. So it's over 8 times what an original institutional would win, with the security of the Ethereum blockchain and with no custody of their coins. Because nowadays, for you to access the protocol, you need to pass through several steps, which include depositing fiat to an on-ramp, which is Binance, Coinbase, in Brazil, Foxbit, Mercado Bitcoin, and for then buy tokens and then move these tokens to a wallet and then connect this wallet to the protocol. So Compound Treasury will make this whole process easier, as institutions will just need to make a wire and then they will take care of the rest. This will possibly be one of the major changes as it's the first real world application of blockchain in the real world. So we are looking forward to this event. So how does the Compound protocol work, and what is the Compound protocol? Compound protocol is just a code base which allows lenders and borrowers to interact with each other via smart contract. So how does it work? Lenders simply deposit any type of token. 3 examples are USDC, which is digital dollars, Bitcoin in the form of wrapped Bitcoin, or Ethereum. They supply these tokens in the protocol, and the protocol will then grant loans to borrowers. And these borrowers will pay a borrow interest, which consists of the supply interest and the reserve interest to the protocol. The supply interest goes directly to the lenders, and the reserve interest stays with the protocol. It's a type of cushion for the protocol at the moment, but in the future, it could be used to distribute dividends and used for contracting several types of upgrade to the protocol. So here it's important to understand that all types of loans are over collateralized. So there are basically no credit risk. So one example is that if I deposit $100, I can only borrow $60. So all of the borrowers of the protocols are actually also lenders to the protocol. So there are no credit risk to the protocol, as a protocol main aim is to be the base layer of the spot interest rate market and be the safest bank in crypto. So they are extremely careful on which tokens they allow to deposit to the protocol. And this ensures that the protocol is extremely safe, and at the moment it's the safest, actually the safest bank there is. So how does the digital lending compare to the traditional lending? What are the pros and cons? So why would I want to deposit in the protocol and not in the traditional money markets? Firstly, the interest, yes. But the second is that in the digital lending, there are several costs that the blockchain space cuts, which includes the loan application, loan processing, originations and underwriting, loan servicing, loan maintenance, IT, collection, and risk cost. All of this is codified and put in the protocol. So everything is automatically and settled in the blockchain. So this cuts all the costs you had. This is why the protocol is able to offer better interest rate and be safer for lenders and also borrowers. So let's have a look at the compound market cap and turnover. So in the graph in the above screen, we have the outstanding market cap and the realized market cap. The realized market cap, it's basically the weighted average of the amount of money that entered actually the protocol. So we can see basically one way to analyze it, if the price outstanding market cap is below the realized market cap, it's extremely undervalued. The realized market cap is like the book value, okay, of the protocol. So we can see that at the moment it's the realized market cap, it's below the outstanding market cap. This was due to the noteworthy event of Compound Treasury. So as soon as the news came out, Compound rallied more than 100%, but it's still extremely undervalued, as we'll see later. So the graph above shows the supply held by each specific token holder. So how much of the supply is held by people who hold more than 100,000 tokens, how it's changing over time. So let's analyze it. So the supply held by the whales, I'm gonna say the mega whales, the 100,000 plus token holders, it's decreasing over time because basically the protocol distribute tokens to everyone who uses the protocol. So if I'm a lender to the protocol, I will receive COMP tokens because I'm supplying liquidity to the protocol, and the protocol has an incentive program for several years to distribute COMP token for anyone who uses the protocol. So, and one of these addresses is the Treasury address, and it's distributing tokens every month. So this is why you can see a decrease in the supply held by the big players. So it has noise there. So we can't look at it and say that actually whales are selling. But we can look at the whales, which are the people who hold between 100,000 tokens and 10,000 tokens. And we can see that they are accumulating since April. And below that, we can see that every other address is also accumulating tokens, with the exception in June of this month, the token holders which hold 100,000 tokens to 1,000 tokens had a decrease in 8.4% of the supply. This was due to the market crash, and we can probably say was people taking some profits off the table. So let's compare Compound to its peers and to the DeFi space and to Bitcoin. So this graph is updated up until today. So there are no delays in the data. So we can see that Compound is doing better than the average DeFi. We can compare it to the DeFi perpetual futures, which is like an index for all of the DeFi space. But it's doing worse than Aave, which is currently its main competitor at the moment. But we'll see later that Aave and Compound are different beasts, and we can't compare them directly. And as Compound seeks to be the safest bank in crypto, and Aave seeks to be a complete bank with several other features apart from its spot interest rate market, and Compound focus solely on the spot interest rate market and security. And we can see that all of DeFi space is doing better than Bitcoin. Bitcoin year to date is up only 10.9%, and Comp is up over 160%. So let's dive into the protocol. Again, as Compound is built on top of a public blockchain, we can see everything. Its balance sheet updates every block, which is about 5 minutes. And we can see how each of the tokens inside of the protocol changes, updated in real time. So we can actually measure the health of the protocol every moment. So let's dive into the protocol. So the main pool sizes are USDC, which is digital dollars, DAI, which also digital dollars, Ethereum, Bitcoin, USDT, which is also digital dollars, Uniswap, which is the largest decentralized exchange, Comp and Comp token. And we can see that its stable coin, which is dollars to total ratio, is 63%. So we can immediately say that 63% of the protocol consists of dollars. So we can actually interpret this as the protocol total value locked won't oscillate as the market oscillate as much, as most of it is dollars. So let's dive into the suppliers. So Compound has 315,000 suppliers, being the main suppliers going to USDC, which is digital dollars, with the average supply being $13,000. Its total issued debt is $4.2 billion, and its main debt issue is dollars also, which is USDC and DAI. And the current number of borrowers is 8,218. And we can see that the average debt is like above 100,000 for every single type of borrow. So we can see that Compound is aiming at actually institutional investors and not retail investors. This is extremely important later as we analyze its main competitor, Aave, which is actually targeting mostly retail investors. So how does the reserves of the protocol vary? So basically, for every borrower, Compound receives two types of interest: the supply interest, which goes directly to the lenders, and the reserve interest, which goes to the protocol as a net revenue, we can say. So it means income stream are from stable coins, which is DAI and USDC, and the pool utilization rates are extremely low at the moment, as we are in a scenario which the market is unlevered, as May occurred several events of unleveraging of the DeFi system and of the digital asset space. So the protocol is generating less revenue than during periods of leveraged space, because the Compound protocol generates revenue based on the interest rate it charges, which has a function directly related to the utilization rate of the pools. So basically, utilization rate is how much the pools are being used. So if the utilization rate is 55%, it means that the pool's capacity is only being used 55%. So the interest rate is actually low. The lower the utilization rate, the lower the protocol interest rate charges to the borrowers, and so the lower its revenue. So this is extremely important, as we can see the utilization rate as a main factor affecting its gross profit later. So the chart below shows the revenue evolution since January, and that decomposed by supply side revenue and reserve revenue, which is actually the revenue which goes to the protocol. The supply side revenue goes directly to the lenders, and we can see it more or less as a cost associated to it. So we can also see the multiple evolution, the P multiple adjusted. So the P is solely based on the revenue generated, which goes to the protocol, the reserves. So we can see that multiple average for the past 6 months is more or less 90 times its earnings. It's extremely low for a protocol, which we'll see later, that grows extremely rapidly. So this is extremely important, as later in our evaluation, we will use one of these multiples to do our valuation. So we can see that from April to May, the protocol dropped its revenue. This was due to Aave launching its staking program, which means that now Aave also do this incentive program, which means that it's also attracting capital by allowing lenders to receive the Aave governance token for when they use the protocol. So this basically steals some of the market share of Compound. This is why it was the revenue drop. And also in May, we had the liquidation event, which lowered the interest rate and lowered the gross profit of all the major DeFi protocols. So let's dive into the two major pools and see the concentration. So in the top left dark box, which is the USDC inside the protocol, we can see that the interest rate is extremely low, and it's after the leveraging event. In the yellow graph, we can see that in April and May, interest rate were reached as high as 15%. So the gross profit of the protocol reached 15%, and now it's between 3 and 1.5%. So it's a big deleveraging. This was due to people being liquidated and the utilization of the pools being dropped. So, and we can see the top positions of the USDC market. It's the largest position consists of $200 million, and the others being consistent of 200 to 50,000. So it's not concentrated. And in the left black box, we can see the DAI market. It's also a stable coin. So we can say the same for the pool. We can see that it was extremely leveraged in April and May, and now it's deleveraged. So its gross profit fell a lot. The revenue composition of the protocol consists of 92% from stablecoin, and only 8 to 9% comes from other types of lending. These others include Bitcoin, Ethereum, Compound, Uniswap. So for our analysis, we will just focus on the stablecoin part of the protocol, and our whole valuation will be based on the stablecoins. So let's dissect the users. So how the user base growing, and are users coming back to use the protocol? So we can see that, again, using on-chain analysis and by the protocol being built on top of a public blockchain, we can see that. So we can see that the protocol has been a growing user base for the past several months, and new users are still coming to the protocol, and the rate of return of borrowers is as high as 50% now, and it reached a peak of 65.6%. So the main borrowers are users which already use the protocol. This is good to know, because if they didn't like the protocol, they wouldn't be coming back. So this is extremely high rate of return for users each month. And in the supply side, which is the blue bars, we can see that new suppliers are coming every month in an average pace of 9,000 new suppliers every month. And from these suppliers, we can see that an average of them, 32% are suppliers which already use the protocol. So it's extremely high rate of supply rate to the protocol. We can see that in November, there was a crash of of existing rate of return. This was due to the protocol being exploited, which occurred in the end of November. This has extremely bad for the protocol, as since then, the protocol rate of new users supplying to the protocol diminished a lot. But it reached a peak of 40,000 new users using the protocol to supply tokens in November. The exploit happened at the end of November, so we only could see the effects it had in December. So let's explore the DeFi space. So the number of unique DeFi users in the space, which means new wallets using the DeFi space, is growing at a pace extremely rapidly. If we can see below each month, the variation, it consists of between 40% growth per month in August, and now it's June, 10%. The average of these months is 20%. So the DeFi space is growing at a pace incredibly fast. So in July 2020, we had only 308,000 users, and by now we have almost 3 million users. This is extremely interesting, and DeFi is being adopted at a pace that we have never seen before. Even in times when the market is crashing. In June, we had a user base growth of 10%. This is incredible. In time when the market crashed 50%. So we can see this as DeFi being actually used by people and not being as a tool of speculation. So how is the digital asset lending space? Though the total value locked now consists of more or less $28 billion in whole of the lending space, and this is decomposed by the three major players, Maker, Compound, and Aave. Currently, Aave and Compound are leading market share, with Maker being third and others being fragmented in several other lending protocols. This is the market share based on total value locked. And below, we can see the monthly DeFi revenue of the three major protocols, Aave, Compound, and Maker. We can see that until May, revenue has been growing rapidly. But from May to June, which we had the deleverage event, where the revenue from all the protocols dropped drastically due to the unleveraging, due to interest rate falling, due to less speculation. People stop using these protocols to speculate and trade. And the percentage in each respective bars represent the market share in terms of revenue. So we can see in May, Compound, let's analyze since April. In April, Compound had 57% of the revenue generated in the DeFi space. Maker had 13, and Aave had 30. From April to May, Aave launched its incentive program, so it's still market share from Compound. And this is extremely peculiar, as it shows that people actually are supplying tokens to this protocol to gain these incentives also. So from April to May, Aave still some of the share of Compound. But it's extremely interesting to notice that from May to June, Maker won 4% in market share. This is not relevant because Maker has other branches of revenue. When market crashes, it has a branch of arbitrage, it has a liquidation branch, so it gains other revenue streams from the space. So we can't interpret as Maker being better bank. It just has several income streams which helped it gain some market share in the times of crash. And Aave and Maker both lost 2% in market share. So how is the net profit of these protocols? So we can interpret the protocol revenue as percentage of total net revenue as net profit. So basically how much of the actual revenue goes to the protocol. So how much value is added to the token holders. So Compound actually has a net profit of 11.3%, Aave 4.4%, and Maker 100%. This is extremely interesting, as we can see that Compound actually adds the most value to its token holders. So what market Compound is actually trying to address? What's the total addressable market of the protocol? So Compound is trying to be the safest bank in crypto and act solely on the spot market. So we can actually understand this as Compound targeting the broad money supply of the world, the M2 supply, which actually would consist of $96 trillion. This includes coins, banknotes, money market account, as well as savings, checkings, and time deposits. these are all spot markets. So basically, if I click one button, I can receive my money instantly. I don't have to wait time. There are no, we can see these as no credit risks. And Aave is actually targeting the whole global debt and the money supply. So it's a different beast with different risks in different markets they're addressing. Here in the fund, we focus only in the simple and with the most desirable protocols. We call them rice and beans, and we only invest in protocols which we know the whole risk component of it. And Aave, as they're targeting the global debt, they have fixed interest rate, and when you add fixed interest rate to the protocol, you add a whole new section of risks that the protocol offers to its token holders and governance token holders. So it has a risk component to it, which actually we can say that Aave had a greater upside, but also has a greater downside. So here in the fund, we'll focus only on compound firstly. So the current DeFi market share of the M2 is currently 0.027%. So currently the total value locked in the lending protocols is $27 billion, and the whole money supply consists on M2 consists of $96 trillion. So this is 0.027%. This is extremely important to know, as the market share is extremely low, the upside is really high. So our whole valuation will be based on how much market share the DeFi space can steal from the money supply of the whole world. And the chart below, the reserve currency M2 growth is the M2 growth of the United States dollars. We can see by that in the past 10 years, the growth has been an average 9%. And from the last 2 years, 2020 and 21, the growth has accelerated due to the COVID crisis and central banks money printing. This is extremely good to the protocol, which means that more money will be flowing to the protocol, more revenue will be generating. The more M2 grows, the more money that will be available for the protocol. So, as I said earlier, we will only explore the revenue generated by stablecoins. So let's analyze how are stablecoin in circulation growing in the blockchain space. So by June 2020, there was $6 billion, $6.8 billion in stablecoin in circulation. And by June 2021, we have $62 billion. So it's over a 10x increase in the span of 1 year. This is a compound monthly growth rate, CMGR, of 15%. Incredible. So how is the interest rate evolving in the protocol? So below we have a graph of the interest rate charged by the two main protocols, Compound and Aave. This is for you to see that the interest rate were extremely high since from February to May. They were between 6 and 15%. They oscillated. So this is good for us to know, because this is the gross profit of the protocol. The revenue is extremely correlated. It's 100% correlated to the interest rate they charge. So our valuation will be based in a scenario, unlevered scenario, which is the safest scenario we can make the valuation, and will be based in a scenario of unleveraged event in an interest rate between 1.5 and 2%. So let's start with our valuation. So in the table below, in the left right corner, it's an income statement of the protocol. Let me explain this briefly before going through the matrices. So firstly, we need to understand how the value lock in the DeFi lending space, it's evolving. So currently in the second quarter of 2021, we have $25.33 billion locked in the DeFi lending protocols. And this value locked is basically a percentage share of the global M2. So basically, our main thesis is that M2 will flow to the DeFi lending space due to it decreasing costs, its efficiency, its global spam, and due to better interest rate, obviously. And our valuation will be based that what percentage of the DeFi share of M2 is on DeFi. So based on this percentage, we'll assume a value locked in the protocol based on its market share of the space. Okay, so in the second quarter of 2021, there was 25.33 billion. The value locked in the protocol is $7.8 billion, and the protocol outstanding debt is 5.6%. The outstanding debt is the protocol utilization rate, so how much debt is being used issued by the protocol. So having this in mind, we can then assume a gross margin, which is the interest rate the protocol charges, and we will assume an unlevered event, which we will charge an interest rate of around 2 to 3% per year. So we can see by that in the second quarter of 2021, its interest rate was 1.7%, which is an annualized interest rate of more or less 8%. This includes a period of levered, so we won't include this 6 to 5%. We will just include the unlevered phase, which is more or less 1% per quarter. So we'll use a gross margin of 1% per quarter for this valuation. And the net revenue, we will use 0.2% of this 1.7%, which is basically more or less 11 to 14% of net profit. So having this in mind, we can just proceed to the first matrix. So in the top row is how much the DeFi grab of the M2 global supply. And in the column coming down here is what is the market share of the compound protocol in this space. So our base case scenario is that the DeFi share of global M2 is 1%. So basically, if the total M2 supply globally is $96 trillion, 1% of this is $960 billion. So we'll assume that there will be $960 billion inside the DeFi lending space, and the market share of the compound will stay stable, fall a bit to 24%. So this would include an upside of 6.7 times multiple on invested capital. And we're assuming several things in this valuation. So the main assumptions are the forward multiple is 28. As we saw earlier, the current multiple is around 90 to 100, it oscillates. So we'll assume a multiple, which is the average of the NASDAQ major tech companies, which is 28. And we will assume that M2 global money supply isn't growing, which is not true. It had a growth rate of 7.7% in the last 10 years. So we also being conservative here. And there's a constant pass-through. The growth, the stable point growth rate to the DeFi, to the total value locked in the DeFi lending space is the same. So if there's an increase in the stable point growth in 10%, the growth rate in the total value locked in DeFi is also 10%. And the scenario will remain unlevered. This is low borrowing rates. So we'll assume a low interest rate, a low gross margin. This is also not true because we know that the average gross margin in the last 12 months is way above what we're assuming in this valuation. And in the top matrix, we can analyze perfectly the risks and calculate what we need to look out when we're looking into the protocol. So in the column DeFi share of M2, we can know exactly how much M2 is going into the DeFi lending space. We have this data in real time, so we can follow this data really closely by the growth in stablecoin really precisely. And the market share, we can also follow in real time how much the compound is gaining market share in the space. So it's also really interesting. So we have a DeFi, a macro economic variable in the top line, 1%, 1.6%. And we can see if the DeFi share of M2, if 7% of the global M2 falls in the DeFi space and market share of compound actually grows to 40% of the space, which actually should happen because compound aims to be the safest bank in crypto, zero credit risk. Its share should increase. It should gain the most market share because people will seek the safest place first and then go to riskier protocols to gain extra interest rate. So actually our base case scenario, which is a upside of 6.7 times, should actually be way more. And in the bottom matrix, we can see the time horizon for this to happen based on the growth rate of stablecoin. We can see that the growth rate for the past 1 year is 15% monthly. And we will be assuming for this a growth rate of 10% to 12.5%. So we are actually aiming at 6.7 times our investment in more or less 2.5 to 3 years. And we're actually being extremely conservative here. So let's do an internal rate of return analysis. So the three matrices will vary depending on the market share that compound has. So depending on the market share, compound gains or loses will have different internal rates of return. So our worst case scenario is compound loses 75% of its market share, of its current market share. And we'll have the first matrix. Let's use our base case scenario, which is DeFi market share of M2, it's 1%. So in our base case scenario, we'll win 31% annually for 2.5 to 3 years, which is extremely good rate of return in our worst case scenario. In our base case scenario, compounds remain with its market share of 24% and has a growth rate of 10% to 12.5% monthly in the stablecoin. And this is a internal rate of return of between 77 to 103% annually, which is extremely good also. In our best case scenario, we'll win between 102 and 140% annually. Also, I must remember you that we're assuming an extremely conservative scenario, and which the multiple is 1/4 the multiple it is at the moment. M2 global supply isn't growing. The scenario is unlevered, and there's a constant pass-through. The only non-conservative assumption I'm making here is the constant pass-through. So we can see that compound is extremely interesting investment and noteworthy, as we can see now by its risks. Compound in the space has the lowest risks, and this is good for when making investment decisions. As Oracle manipulation, we had this event already. It occurred, yes, but the probability now is extremely low. We can see its likelihood, it's rare, in its significance, it's major. So the probability is low. Technical risk are smart contract risk, as compound aims to be simple rice and beans investment and solely focus on spot interest rate market. Its likelihood is rare, and its technical risks are severe if some type of smart contract error occurs. So we can see the probability is medium. And it's noteworthy that in the other lending protocols, we can say that the probability is possible because there are several other codes in the protocols as they aim to offer fixed interest rate and other types of features. So token incentive risk is the risk that the incentive offered by the Compound protocol, which is to give governance tokens to all of its users, will fade over time and will expel suppliers, clients from the protocol. We can say that these clients are only there to gain these incentives. So we can say that this is also a risk to the protocol, but we can say that the probability of this happening is unlikely. And as the protocol has an exclusive feature of being just safe, it's like the Bitcoin of the DeFi space. It has one sole feature to be safe. So it has a competitive advantage toward its peers. So governance risk, we don't see major governance risk. It's rare. We see it's rare, and its consequence, if it happens, it would be moderate. Because as we saw earlier, major token holders, investors are extremely old school, and they know exactly what they're doing. We can see this by their portfolios, by who they invested before, and we can say that the likelihood of this happening is rare, and the consequence will be, if this happens, will be a 10 to 20% loss, so it's low probability. So giving an overview, Compound is extremely safe. It's the safest one there is. And people will first seek the safest one and then risk the others. As it is in all types of investment, they don't have a clue what they're doing. And blockchain and DeFi, it's extremely new, and we believe that people will seek the safest one first, the simple one first. And Compound, adding the Compound treasury, will attract this M2 capital extremely faster than other protocols. So, final remarks. The major risks to this competitive environment in the DeFi lending is threats of new entrants, but this risk is extremely controlled, and Compound has a competitive advantage towards its peers because as it's one of its main partners now is Circle, which is from Coinbase, and Coinbase is one of the main backers of the protocol, early backers. We can see this because Coinbase added the token in less than 10 days. They also made a partnership to add Compound treasury, and we can see this as Compound being a head start of the players in the industry. And the threat of new entrants is high because it's a code, it's open source, people can just copy paste the code, and in a blink of an eye, people have a bank, basically. But they don't have all the safety features, the governance Compound has, the partnerships Compound has, and they don't have Compound treasury, which will be an on-ramp for institutions. Threat of substitutes are extremely low, as Compound offer not only Compound, but all of the protocols inside of a blockchain has lower cost than almost any other banking structure outside of blockchain. The intensity of rivalry is extremely low, as there are no maintenance costs, just the fees a user pays to use the protocol. Bargaining power of suppliers, medium, and the bargaining power of customers are medium. This is due to easily take capital of the protocol and put in another protocol. Let's say, like if the user experience is not good in the protocol, people can just click on a button and take the cash out and put in another protocol. But suppliers and customers have no bargaining power in the interest rate they charge, they're willing to pay. So they're just price takers. They're not price makers in the space. For someone to be a price maker, they must have billions and billions of dollars. And the moment this is extremely low probability of happening. So in summary, we can say that the score is 0.6. It's a medium intensity in the space. And being the main threat is being new entrants and Compound having an advantage in that. We can say that the protocol is in good position. So for questions and inquiries, please contact me via email or Twitter with me or my junior analyst. And my final remarks for this protocol is that Compound is extremely simple protocol, but extremely powerful. It's targeting the whole M2 global supply and targeting the whole spot interest rate market. It's allowing people from all over the world to have fair interest rate and allowing people from lower income countries to have access to interest rate, let's say 2 to 3%. This is a tool, in my point of view, in our point of view, that will change the world and will basically allow people to level the playing field between large corporations and small corporations, and the interest rate will be fair for everyone. Everyone will be a price taker. There will be no advantage for big players, let's say. And we see this as extremely beneficial for not only our portfolio, but the world, the productivity of the world, and especially for the frontier markets in Africa. We see this as a tool to unlock the potential GDP of countries that don't have a financial system, and those who do have a medium financial system that charge its customers an interest rate of 15 to 20% to borrow money, abusive interest rates, and this will allow people to grow and borrow money to grow new businesses, and the productivity has a chance to increase a lot if the world adopts this protocol. And we choose Compound protocol and not other protocols due to its safety reasons, due to it being simple, due to its competitive advantage, and due to it already having a real world application. And for the risks being extremely controlled, we can see the growth rate of the stablecoin. We can see how the DeFi lending space is grabbing the global M2, and we can see how the market share of Compound is evolving over time. So we can actually track all the risks, and we can control any downside risk if a tail risk event occurs. So we believe Compound is extremely good investment in the long term. We believe that it will benefit our portfolio. And for any other questions and inquiries, please feel free to contact me. If you fail to understand any part of it and you want an extra explanation, please also feel free to contact me. And me or my junior analyst will be in touch with you as soon as we can. And special thanks. And our next presentation will be on Uniswap, and we'll release it in the next 15 days. And thanks everyone, and see you. Bye-bye.